Hi everyone, I'm James. Most people think extreme wealth comes from diversification and managing risk. But when you look at the people who have actually built extreme wealth, a different pattern appears. In this video, we look at three groups: founders, families, and early employees, and how extreme wealth is really built. There's through concentration, not diversification. Take a look at the 10 wealthiest people in the world. Despite operating in different industries, they share a common characteristic. The vast majority of their wealth is tied to one or two companies. Elon Musk with Tesla and SpaceX, Mark Zuckerberg with Meta, Jeff Bezos with Amazon, Jensen Huang with Nvidia. This raises an interesting question. Why would some of the wealthiest people on Earth choose to remain so concentrated when conventional investing wisdom tells us to diversify? One reason founders remain highly concentrated is control. Take Michael Dell and Larry Ellison. Despite already becoming extraordinarily wealthy, both still own roughly 40% of their companies. This large ownership stake gives them control in three important ways. First, large ownership stakes provide voting power. Founders can have greater influence over important corporate decisions. Second, ownership helps shape the strategic direction of the business. In 2013, Michael Dell led a buyout that took Dell private, allowing the company to focus on long-term transformation away from the pressures of quarterly market expectations. Finally, concentration supports a long-term vision. Founders often think in decades, not quarters, and a large ownership stake helps them to pursue that vision. For many founders, concentration is not just about wealth, it's also about maintaining control of the business they built. Another reason many wealthy founders remain concentrated is tax efficiency. In many tax systems, unrealized gains aren't taxed until the asset is sold. As long as an investor continues to hold an asset, the gain can keep compounding without triggering a tax liability. In contrast, selling shares typically creates a taxable event. This is one reason Warren Buffett has often highlighted the value of deferred taxes. Every dollar that remains invested can continue compounding rather than being paid to the tax authorities today. For founders with large stakes in successful businesses, remaining concentrated can therefore have significant tax advantages. A third reason founders remain highly concentrated is conviction. Founders often believe their best investment is the company they built, and that belief is most revealing during near failure, not success. Take Elon Musk. After selling PayPal, he concentrated his wealth into Tesla and SpaceX when both were close to collapse. In 2008, Tesla was weeks from running out of cash during the financial crisis, while SpaceX has failed multiple rocket launches and was down to its last attempt. Both companies were effectively one step from ending. Musk kept funding them through that period. Jensen Huang followed a similar path. In Nvidia's early years, the company faced intense competition, product setbacks, and real financial pressure. Survival was uncertain at multiple points, yet Wang maintained a highly concentrated stake and stayed committed to the long-term vision. For many founders, concentration is not passive risk-taking, it is conviction under stress, a belief that even in crisis, their own company remains their highest conviction investment. While it makes sense for passionate founders to retain significant ownership stakes in their companies, how about families? How does concentration create multi-generational extreme wealth? A clear example is the Walton family and Walmart. Sam Walton founded Walmart in 1962, but long before it became a retail giant, he was influenced by his father-in-law, who encouraged him to bring his family directly into the ownership structure of the business. As early as 1953, the Wharton family formed a partnership between St. Wharton, his wife, and their children, with equal ownership and a strong emphasis on consensus-based decision-making. Rather than treating Walmart as a source of personal consumption, this arrangement encouraged the family to retain capital within Wharton Enterprises and reinvest it over time. It created discipline around wealth preservation and ensured ownership remained unified rather than fragmented. Notice that Walmart wasn't founded until 1962. The ownership structure came first. As Walmart grew, this structure became extremely powerful. By the early 1990s, the family still controlled around 38% of Walmart stock. This level of ownership provided one of the strongest protection against takeover, effectively keeping the company under family influence. It also allowed ownership to be transferred early, significantly reducing estate and gift tax burden and locking in the structure for future generations. Over time, even as the family has sold portions of its holding, Walmart's share buyback helps sustain a very high level of ownership concentration. Today, the Wharton family collectively owns approximately 45% of Walmart, and three Wharton descendants rank 11th, 12th, and 13th on the global billionaire wealth list. The key takeaway is that when concentration is built into your ownership structure, it becomes a mechanism not only for creating extreme wealth, but also for preserving and compounding it across generations. Beyond founders and families, concentration can also create extreme wealth for early employees. Take Steve Ballmer. He joined Microsoft in 1980 as his 30th employee and first business manager. At that stage, he negotiated an equity stake that would eventually grow to about 8% of the company. Over time, he sold only a portion of his holding but retained the majority for decades, maintaining a highly concentrated position in Microsoft. As Microsoft grew into one of the world's most valuable companies, that concentration compounded dramatically. At certain points in recent years, Ballmer's net worth has even surpassed Bill Gates, largely because Gates has been steadily reducing his Microsoft exposure through major donation to the Gates Foundation, while Ballmer has remained almost fully concentrated in Microsoft. Today, roughly 90% of Ballmer's estimated $130 billion net worth is still tied directly to Microsoft stock. The key point is that extreme wealth doesn't require founding a company, but it does require sustained concentration in the single extraordinary asset. Across founders, families, and early employees, the paths are different, but the pattern is surprisingly consistent. Extreme wealth rarely comes from spreading investment across many things. It usually comes from staying concentrated in a small number of extraordinary assets. Whether it's conviction, ownership structure, or simply getting in early and holding on for a long time, the same idea keeps coming up. Concentration is what turns participation in great companies into extreme wealth. For individual investors, the key takeaway is a simple but important truth. Most extreme wealth is built on concentration, not diversification. I hope you found this useful. Feel free to leave your comments below. Stay focused, everyone, and I will see you next time.